It was the 3rd of April 2020. The first signs of the coronavirus pandemic were already visible. There were rumors of an impending lockdown. Businesses across the globe were beginning to battle an unprecedented crisis. Stock markets nosedived at every sign of bad news from China. And in the midst of this, one of India's premier private sector banks rolled out few more digital services. But its valuations crashed to multi-year lows. HDFC Bank has never been completely immune to stock market crashes. Whether in 2009 or 2020, shareholders took the stock of the banking entity to the cleaners at every crisis. After all, no business is as closely linked to the economy as banking. Also, despite HDFC Bank's reputation for consistency in asset quality and profit growth, the bank has been at the receiving end of investor apathy from time to time. But what explains the fact that in 2023, when Sensex and Nifty are near all-time highs, the stock of HDFC Bank is once again trading at near rock-bottom valuations? Agreed, the bank is no longer its old nimble avatar. Rather, the reverse merger with parent HDFC Limited has brought the bank sufficient near-term challenges. Being the 7th largest bank globally does come at a cost. But HDFC Bank is no stranger to growth and acquisitions. Rather, from its early days, the bank has absorbed relatively small entities like Times Bank and Centurion Bank. And every time, the synergies have paid shareholders rich dividends. In 2023, the troubles, though in-house, can cause some unenvisaged dips in margins and asset quality. Not one to offer end-moment surprises, the management of HDFC Bank chose to warn analysts about the possible bad news in the coming quarters in the latest con call. But like it typically happens for consistent entities, even the slightest aberration, even for a temporary period, is not pardoned. The warning of muted margins and slightly bloated NPAs has sent the stock price back to April 2020 valuations. Question is, does HDFC Bank deserve to trade at such historic lows, that is price to book value below 3 times? Should its current shareholders panic? And more importantly, can this be an opportunity for value buying? Now, if you're a potential investor, you need to conduct detailed due diligence on any stock to form your view. But this is not about a buy or avoid view on HDFC Bank. Rather, it's about drawing up a checklist that helps you vet the distorted valuations of certain entities that rely on macro factors. First, will the bank fund India's capex drive? India's economic growth over the coming decade will be a mix of self and bank-funded growth. Banks, especially private sector banks, will play a crucial role in the latter. The coming wave of capex in both public and private sector entities will keep credit demand steady. Being one of the most premier banks in the country with a strong network across domestic and overseas corporates, HDFC Bank is bound to be a significant lender. Point 2. Will Indian government continue to pursue financial inclusion? Now, financial inclusion has been the key to both financialization and digitization of the economy over the past decade. Applications like UPI have made banking services accessible to the remotest corners of the country. HDFC Bank has the first mover advantage in new technology initiatives like digital currency for financial inclusion. Finally, will Indians continue investing in financial assets? The share of financial assets in total household assets in India has doubled over the past decade. The trend is unlikely to reverse since financial investments are being incentivized. Its exposure to non-banking financial entities like insurance and mutual fund through subsidiaries makes HDFC Bank well placed to capitalize on the trend of savings moving towards financial assets. This in turn offers the bank huge advantage of surplus low-cost deposits. And will the banking sector get more competitive? The emergence of the new HDFC Bank has invited comparisons with its global banking peers. But the sobering fact is that China's ICBC is still way ahead, especially since that country accounts for 15% of global trade. However, domestically over time, smaller Indian banks and NBFCs are expected to consolidate. Hence, a large bank like HDFC Bank may feel the heat of competition from domestic players looking to cannibalize on its market share. Nevertheless, with its profit focus, it is unlikely that HDFC Bank will compromise on margins or asset quality for growth. Now that was about the macros. Coming to some specifics about how the merger with HDFC will affect HDFC Bank. Take disbursement growth. HDFC Bank originates materially lower mortgages versus other peers, as the bank was always an origination partner for HDFC Limited, and the service capability or underwriting capability was always with HDFC. With the merger, these artificial constraints to growth will disappear. Hence, the bank will be able to leverage upon its large footprint to originate more housing loans. Mortgages are one of the largest segments within retail lending. HDFC Bank had a materially lower market share in housing relatively to its own overall loan book market share. Only around 11% of its overall loan book is from housing. With the merger, the bank gets access to the largest market within retail loans, and this will further support its presence as one of the most dominant retail lender in the country. According to estimates, the consolidated entity will have 20% plus market share in mortgages. Then comes the ability to cross-sell to a broader set of customers. As per the HDFC Bank management, 70% of the customers of HDFC Limited and its subsidiaries do not bank with HDFC Bank, and 8% of the HDFC Bank customers have mortgage products from other mortgage providers. Post the merger, the bank will get access to a larger pool of untapped customers who can be cross-sold both mortgages and other products within the HDFC empire. I'm sure you're wondering, how about the financials of the merged entity? Will they be better? Going by HDFC Bank's history of mergers, even if there is a temporary dip in margins and return ratios, they are unlikely to dent the long-term fundamentals of the merged entity. More importantly, HDFC Bank's rigor in sustaining the quality of assets will hold good over the longer term. Therefore, the dent in book value due to NPAs is ruled out. So the main question, should investors shun HDFC Bank on the basis of near-term woes? Since bank balance sheets and valuations are extremely vulnerable to non-performing loans, valuations can slip progressively. It is the big I that is to be blamed, what Warren Buffett calls the institutional imperative. The I am referring to is the tendency of companies to do things because everyone else seems to be doing it. Buffett wrote this in his 1989 letter to shareholders. My most surprising discovery, the overwhelming importance in the business of an unseen force that we might call the institutional imperative. Even some of the biggest and reputed banks globally have fallen from grace as and when they were reported to be cheating shareholders with a rosier picture of their performance. So the fact that HDFC Bank is warning potential investors of near-term challenges should in fact be seen as a sign of transparency and focus on long-term value creation. HDFC Bank has built its reputation of choosing quality over balance sheet size for nearly 3 decades. The fact that the bank has commanded premium valuations for most of this period shows investor trust in the bank's quality and consistency. Hence, unless there's reason to believe that HDFC Bank has underreported the margin challenge or asset quality, which could permanently damage its valuation criteria, there is no reason to completely shun the stock. In fact, for investors with very long-term perspective looking for consistent compounders, there is no better opportunity to create watch list with such bargain hunting instances. Hope you like this video. Thanks for watching.